Okay, what's up, guys? This is Colin, and we'll be going over how to make an earnings trade. So I was going to use an example I used last week, which is NVIDIA. It's kind of hard to see, so I'm just going to use kind of a poor example, but one you can use with ticker DE. It's John Deere. So first thing we have to do, and I'm going to show you on here, it's kind of hard to see on my screen, but is you have to find out expected move. Now, how you find out expected move, that's number one, is you do a straddle at the front month. So the front month, I had a tough time with it. It's just, so today's the 23rd, then front month is the next option, weekly, so 4 days from now. So you can see we're about 257 now. So the expected move is about 245 to 270. So what I'll do with these situations, when I'm going to go over two strategies. When I use a strangle, I'll almost always add another week of time right there. That's to December 4th. The reason I do that is sometimes it will go against you and you don't have time. If it's a day left or two, you better be right. Or do you want to take the shares at whatever price? And then I'll go to double the expected move. So if it's at 270, maybe I'll go to 290 or something like that. And if it's 245, maybe I'll go to 235, something like that. Buying power, this is 2,500, as you can see here, or 2,800. And one thing to note when you enter an earnings trade, you can enter it a couple days early, let's say the 23rd, or earnings on the 25th. I'd probably enter it tomorrow, the day before, even a couple hours before, because if it goes against you or some big Vega move, some big high volatility move, then you have that to deal with, and you're not centered. I do these pretty much delta neutral. Obviously, you could be directional. You could just sell put, or you could just have this put component, or you could just have this call component. And you could make the time go a little bit further. I don't like the time too much further than a couple of weeks, maybe just a week. It's kind of my sweet spot. Just because you go a little further, you go to 295 and 230, or 230, 250, 300. But again, what we were doing, making money off of, we self-rating, that's all the time thing. But what this really is, it's a Vega crush. So Vega has changed in implied volatility. So what happens leading up to a earnings on the 25th when it has earnings? The 24th, the change in implied volatility is going to rise. The delta is going to rise at that. And what's going to happen is it's going to make the option price high from Vega. Then when we have a binary event, whether it goes down, up, sideways, up a bit, stays exactly flat, then that's going to crush your Vega because the event has been decided, and you can buy it back usually for 50% profit, 30 higher, and you also have the time value. It's only a day or two that you have the time, but there's only a couple weeks on or a week, so time is starting to make a big portion of that extrinsic value. Just so everyone knows, extrinsic value is an implied volatility premium plus time premium. That's it. We can go over that in a different video. So that's the first trade I would do. You can kind of mess around with it. Like I said, delta neutral. This is 7 delta. Maybe I'll be a little bit positive delta, but again, it's not about the directional bias. It's about the Vega crush. So it doesn't matter where it goes as long as it stays in between these two. So another strategy you can do. The problem with the strangle, it's a short strangle. With this strategy, the issue is that there's no wings. And what do I mean by wings? There's no long option component. So if this, let's say, has a horrible earnings and goes to 210, we're going to take the shares at 235 or 232.5. And obviously, there's some stuff you do to manage it. The first thing I would do, and I can go over this on a different video, if you get breached, so the breach point would be right here on the put side, right here on the call side. Let's say it's on the put side. You immediately roll this up, so then it's right here. That'll cut about 50% of your delta down. And we'll just put you in a better spot. You can obviously sell calls against it. I'm going to give you that a different day. It's kind of complex stuff. I'm just trying to focus on the strategies you use. So let's say you didn't want to risk as much, because on this you make a couple $100. So if you do it on the 24th, you make $100 per one lot contract in a day, which isn't that much, but it's pretty good money. So the other strategy is called Iron Condor, and what that means is literally the same thing, short strangle, but we have what's called the wings, and this protects us. So from 225 to 235, I usually do about $5 wings. So that's 230, 295. Now, again, first thing you're going to notice on this is the credit is much smaller. less than $1. I'm not a huge fan of these. You can obviously just have what's called JBlizzard, where you don't have this component right here, or reverse JBlizzard, where you just don't have this one over here. Whatever you want to do, that will give you more premium. But typically, what I'll do, if you're going to do this strategy, I try to put at least $1. You're probably going to have to move them in, your short strike in, because the long option is just eating up so much that premium. So let's say you move 285. So the issue, this is always the issue with iron condos versus strangles, is that you can't make as much with iron condos, but you can't lose as much. The problem is your break even, the point at which you make a penny or more in profit, is greatly diminished. It comes in a lot because with a strangle, you get pure credit of a short strangle, and that widens your break even far. But with iron condor, you have to pay for this option and for this option. So the credit is $1. So if you're selling it strangle, you have $2. Now you have another $1 on each side to be right. So I like strangles better. I understand people may not have $3,000 in their accounts. Maybe they want to try another iron condor. One thing you should know too is with an iron condor, the Vega crush is going to be much less because the long option component, obviously, they're exact opposite. So you may want to, go $10 wings, which would be the 230 puts to 240 and the 290 to the 300. Just understand that that's $10 right here, 230 to 240. That's $1,000 you could lose, and you only make 37 cents according to this. So yeah, it doesn't seem viable to me. If I was going to do something like that, I'd probably go closer in. And then I'm going to get into on a later video how to manage this stuff. Market's about to open right now, so I'll let you guys go. Let me know if you guys have questions. Thanks.